Good afternoon, everyone, and welcome to today's webinar. My name is Liam, and I am the Business Development and Partnerships Manager here at Simply VAT. At Simply VAT, we focus on kind of international businesses and we help them grow their company's cross-border sales. Us here, we primarily focus on UK, EU, and Canadian markets. However, today we are joined by Matt from the team over at Zamp, who will be running through the essentials of the US sales tax for your company's growth into the new and US markets. Just before we kick off and I hand over to Matt, I just want to go through some basic kind of house rules. So towards the end of today's session, we will have some time for a Q&A. Please do feel free to add any questions that may arise throughout today's session in the comment section, and we will try to get through to them all throughout the end of today's webinar. If we are unable to get through to your question, we will contact yourself separately. Either ourselves or the team at Zamp will be in touch to go through that. And then after the webinar as well, we will be sharing a link to the webinar to watch on demand and other useful resources for your expansion into the US markets. But without further ado, I will hand over to Matt, who will be starting us off today.
Thanks, Liam. I appreciate it. Let's just jump into the agenda here. So we're going to cover some of the basics of U.S. sales tax, what it is, why it matters to you as an international seller selling into the U.S. We'll cover the topic of nexus, which is all about what's the presence that you create in a state to trigger the requirement to collect sales tax. We'll cover some of the craziness of the product taxability and how it varies across all different types of products. I think it's important to understand that. Also, what are the steps to get compliant? Both if you're new and you're just launching to the US, as well as if you're existing, you have an existing business in the US, how do you get to that compliance level? And then the final piece is we'll tackle that hot topic on tariffs. We'll cover that briefly as well. So let's just jump in here. A little bit about me. So I live on Bainbridge Island. It's a 35-minute ferry ride from downtown Seattle if you're ever in the area. I've got my wife, Annie, my kids, 3 kids, and my dog, Ruthie. I had to mention her. I've been in the sales tech space for a long time. So I was actually part of helping build out Avalara's e-commerce practice many years ago. That was actually started on Bainbridge Island. I ran revenue at TaxJar for 5 years. And I've also had the opportunity to present to the Congress, House of Representatives, National Press Club about tax technology. And it's just always very interesting with the whole tariff situation right now for the small business. The SMB that's selling into the U.S. and some of the hot topics there. There's a lot of passion around that in the U.S. and so I will be covering that on this session today. So let's jump into U.S. sales tax. So when you think about U.S. sales tax, right, it's a tax on the sale of goods and services. It's at the point of purchase. So I am purchasing a product or service. I'm charged tax. The seller is required to collect that and then remit it to the appropriate state accurately. So this is going to be different than VAT, which encompasses, the VAT in and out, the purchase side, the sales side. This is much more about everything on the sales side and applying the appropriate rate and then remitting that to the state. And the states don't make it easy. So there's 12,000 taxing jurisdictions in the U.S. And within those, there's obviously the states, the county, the city, and the special taxing jurisdictions. And they overlap each other sometimes. But all of these boundaries have different rates in different states. And they don't align with zip codes, which makes it quite interesting to get an accurate calculation. I talked about the product taxability piece. Right, lots of different products and services that are taxed differently depending on when you sell it, where you sell it, who you sell it to. Of course, there's exemptions if you do a resale business or you're selling in marketplaces like Amazon. That comes into play. There's different sourcing rules as well. Now, anytime you ship between states, interstate shipping from like California to New York, for example, the tax would always be based on New York. But within state borders, when you're shipping within a state, there can be different rules on how the tax is applied based on either the ship from or ship to address. Most states are destination based, but states like Texas, Ohio have origin based rules based on where the product is shipping from. There are unique reporting requirements. So every state has different reporting requirements and formats that you have to do. So this is across 47 states that have sales tax. And of course, you have different schedules in terms of how you have to file. They assign you schedules based on monthly, quarterly, sometimes it's annually, it can change. So all of this complexity for you as a seller is there in the US. You've got these 47 states that essentially are acting, I've heard the comment, sovereign nations. They're acting like, separate countries almost, each of them, with their own rules. Now let's dive into Nexus here. This is by far the one area that we get asked the most questions about. And this is both international sellers, US sellers, like where do I have to collect sales tax? And so first and foremost, physical Nexus is where you have inventory, employees, offices. You may be traveling to a state to solicit business or handle installations, things like that. So that is the first trigger for all states. You're using a 3PL, with your inventory, you're triggering Nexus in a state, and that's the physical trigger. In 2018, the Supreme Court, in a decision of Wayfair versus South Dakota, ruled in favor of South Dakota, allowing states to bind companies to collect based on how much they sell. And that's the whole concept of economic nexus. Right? I've met a threshold based on either order or revenue volume, and it varies by state. We'll cover that in a little bit. But that's the trigger where now you've triggered the threshold in a state, which now requires you to collect and remit in that state. And here are some of the triggers. Now, 21 states look at either revenue or orders, and this is across either a 12-month period or previous calendar year, current calendar year. So they'll look at 100,000 or 200 orders. We have a lot of merchants that will trigger that 200 order threshold first because their ACV is lower, so it's a common trigger. Some states just look at the 100,000, just at the revenue. Some are higher, like California, Texas are at the 500,000 level, bigger states, right? So that's common. And I think the biggest thing about this is some states are now taking away their order threshold. So there's been a couple of states like Wisconsin, for example, that removed the 200 order part of their threshold. And but there are still, again, the 21 states plus DC that have it. But I think it's interesting to kind of track how that shifts over time as a merchant in the US. Do more states follow suit and just go towards revenue and start to eliminate some of those order thresholds? But as of today, it's roughly half the country in terms of sales tax that have that order threshold in place. This is an interesting thing we did. What we did was we kind of reverse engineered the whole concept of economic nexus. So we took personal consumption expenditures by state, and then we applied it as an overlay to each state's economic nexus rules, which we just covered on the last slide. And what I think the biggest takeaway here is multi-state requirements happen pretty quickly. So if you're selling in the States, you're doing a couple million, you could have exposure 6, 7, 8, 9 states, even if you're only doing a couple million a year. And that will continue to grow, obviously. But when you get to 16 million, you can be in 30, 35, 40 states. I think nationwide, it starts to be around 25 million a year in the US. You start to kind of trigger more of a, towards 25 to 30 million, get towards that 47 state exposure. So I think it's important to understand that as you sell into the US, this can happen very quickly. And being on top of it early on at launch it can be really valuable to your company in terms of reduced risk. So I also know on the international side, it's very common for sellers at merchants that we talk to say, hey, we've established a wholesale strategy. So we're doing B2B. We're working with various retailers. And we're also potentially selling on marketplaces like Amazon, Walmart.com, et cetera. And the biggest thing we hear there is, well, we're not required to charge sales tax in those type of transactions. And that is correct. Now if you do have nexus in a specific state, you are required to report it as exempt orders, but you're not required to calculate the tax. But these sales channels can count towards economic nexus. So, there are states that count both marketplace and, towards nexus. That's 5 states plus District of Columbia. There are states that count both wholesale and marketplace. There's 23 states there. Some don't, by the way. Some don't count either towards economic nexus. And I think it's important because, again, if you start your U.S. strategy with a wholesale or marketplace approach, and you decide, hey, I want to eventually launch a direct to consumer, your brand is building, the brand awareness, it starts to make sense. You want to make that investment. Just recognize that you may already have some exposure based on these channels here today. So I think it's important that, again, you understand that these do count towards some states' view of economic nexus.
Hi, Matt. Yeah, that's super interesting. I just wanted to really kind of, I guess, jump back in here quickly because a lot
Sure.
of things that we hear from, a lot of our clients that we may speak to, they always seem to ask, whether something like FBA would be enough to reach Nexus within a state. Is that something that you typically see, or, you know, yeah, is it mainly like marketplaces that do build up towards that a lot quicker than, say, own website?
Yeah, absolutely. So I think for states that count marketplaces towards Nexus and you're selling on FBA, I think let me walk back a little bit on this is first with FBA, you are potentially triggering inventory Nexus back to the physical side where Amazon houses your inventory. And I think they have distribution centers in 25 or 26 states, somewhere in that range. But if you're only doing marketplace, Amazon will take care of all the sales tax, right? So they handle all the sales tax as part of the marketplace facilitator laws in the US. And so we have some companies that just say, hey, I only sell on marketplaces through Amazon. So I could register where I've triggered a physical nexus with inventory, but I'm just going to be filing $0 returns. So does it make sense for my business? Probably not. But again, to Liam, to your point, if you do start to sell direct to consumer, you have to think about Amazon both on the physical nexus side, where's my inventory being held, what distribution centers, and then also on the economic side, because again, you can do a lot of volume in Amazon. I see it just through my daughter's orders every week. It feels like the Amazon trucks in our driveway at least once a week. So that does add up. And so, I think those are definitely factors that you have to consider. And I think it really starts to matter, again, once you have that direct to consumer strategy in play.
No, that makes perfect sense. Thank you. We've actually also had an audience question, which I think is quite relevant here. So I'm just going to jump in with that because they've
Perfect.
asked at the moment that they only sell on Amazon currently, but they're looking to launch like own website because they only sell on Amazon. Obviously, as you mentioned, Amazon take care of that sales tax. Will the Amazon sales count towards their like state nexus, economic nexus? Is that kind of something that would be something for them to consider?
Yeah, so there will be roughly, I think it's 28 or roughly of the 47 that will count the marketplace sales towards economic nexus. And I think if you are going to launch the D2C, one thing I would recommend is just getting an assessment based on where you have exposure, potentially through your current Amazon sales. The second thing I would say is, think about what is your strategy in terms of volumes. And I look at the concept of materiality. So if I know that Amazon is housing my product in 5 states, and I'm launching a D2C strategy, how material is it, where the sales tax liability, it gets to a point where I should start collecting. So, I think it's something you can look at both in terms of, again, your exposure based on economic nexus, but also the material component, because again, you are going to be triggering physical nexus through the FBA relationship. And I think that's where you can kind of go through, get the assessment based on your forecast. You can even run some liability exposure analysis, based on 1 year, 2 year, 3 year forecast, and make some decisions off of that.
Perfect. The other thing as well, something that's just kind of sprung to my mind, just because I know in some kind of countries this is how it works. Where Amazon acts as that deemed supplier, or the marketplaces generally act as that like deemed supplier, remit and collect that sales tax or VAT. In the US, when you kind of trigger that nexus and you need that registration, do you then have to like collect the sales tax on those Amazon sales, or is it treated completely separately?
Yeah, the Amazon sales, they in 2017, December of 2017, they struck a deal with the state of Washington as a starting point where they're headquartered, to start collecting or remitting on all sales for sales tax in the state of Washington. So Amazon owns the collection and remittance of all sales in their marketplace for products that are taxable by state in the U.S. Every state has now rolled out marketplace facilitator laws. I think Florida was the last one to join, but I think they joined a year or two ago. So, but I believe it's every state has one. So again, you can be happy the fact that, hey, Amazon is taking care of it for you. You just also have to understand the ramifications of nexus when you are working with an Amazon, both from a physical and potential economics perspective, especially again when you start going direct to consumer.
Perfect. That's
Yeah,
excellent. Thank you so much. I will let you
great
continue.
question.
Thank you.
Yeah, so on the product taxability, this is let's go into some of these products that have different. So you have a lot of products in the U.S. are TPP fully taxable, right? You've got electronics and those are just fully taxable products. You buy a computer, it's TPP, fully taxable. There are no rules associated with that. But there are categories that have different rules. And you may have heard of the clothing and apparel exemptions in certain states. What's interesting is like New York City has a $110 threshold. So if the clothing item is under $110, it's exempt in New York City. If it's over $110, it becomes taxable, both at the state and the city level. And then if you sell that same T-shirt out in Long Island, where I grew up, the state rate is exempt if it's under 110, but the county and the special taxing jurisdictions are still applied. So versus the full exemption in New York City. So there's these complex rules that are in place where I don't think they were thinking about the online seller when they came up with these rules. A lot of them were thinking about the companies at various point of sale locations, where they have a specific rate and a specific rules within that location. But when you start selling to all over the state and having different rules within that state based on price and so on, it makes it quite challenging. And food and beverage is another one. There's obviously prepared food, which is mostly taxable throughout the U.S. But then there's, unprepared food for home consumption. There's food that's, has different tax rules associated based on food and beverage, based on how much fruit juice is in the specific product. There's obviously candy exemptions and taxability. So a lot of states will tax candy. Massachusetts was pushing to do that recently because they wanted to hopefully reduce candy consumption, which is kind of interesting. But there's a lot of different rules associated with all these products based on ingredients and so on. And one question, the Uncrustable is exempt in New York. It's food for home consumption. It's considered a snack, which is exempt in New York. So, but supplements, I'll cover SaaS and software on the next slide. digital content, streaming. And when you get into digital and software, it can get really complex in terms of how you define your product. In terms of streaming, whether I have, unlimited access, permanent access, or temporary access to the streaming content. So there's different rules associated with that. Healthcare, medical services get really interesting because, there's a lot of different exemptions for services, professional services, installation, so on. But then, for example, like installation services, when you wrap that with a physical product, you tie the service to the physical product, it can become taxable. So for example, in California, there was a company that was selling, treadmills and so on, and installation services, they install it as is basically exempt in California. But if it's included and required as part of the product, then it becomes taxable. So there's these rules associated with when you take exempt products, and this can even tie to software as well, and match them with a tangible product, it can make everything taxable within that specific product. And then you've got back to school products. That's typically around the August timeframe of every year. There's a group of states that exempt, various school supplies, notebooks, pens, etc., calculators. And you have to match those exemptions. Sometimes it's a week, up to 2 weeks, depending on the state. On the software side, this gets pretty interesting because, we as Zamp is a SaaS provider, and we work with B2B. So there are different rules with SaaS B2B versus B2C. There's a couple states that have different rules associated with that. But you can look at software based on the function it provides. Is it access to data? Is it a specific service that they're offering? How it's delivered, right? SaaS, digitally downloaded, streamed. There's all different components that come into how it's taxed based on that. And then access rights, I talked about that earlier. Is it temporary? Is it permanent? And why this matters is, if you get this wrong, there are some definite differences on how states look at, for example, pre-written software versus software as a service. And we just had a customer recently, international customer, who was defining their product as SaaS. But then they started to explain it in terms of, we have an SDK, we give it to the client, they deploy it in their environment, and it would really fell into a pre-written software. So we had to do some cleanup work there and get them on the right track in terms of how they define it, because it's important to understand this because the states have all their definitions. I will also tell you this. Sometimes the states don't always agree. So there can be somewhat of a conflict or a gray, let's call it a gray area, where one state may have a certain definition of a specific product type versus another state. I think the biggest thing we work on with customers is, what are you comfortable with based on the product you offer? And let's apply that associated logic, which will be, whether it's exempt, partially exempt, or so on within the state. And that's something that you can stand by, right? So correctly defining your product, even again, we go back to the 47 states and everyone has their own, their own rules. You're trying to create one cohesive strategy across the US. And sometimes there is a little bit of a gray area. So you want to make sure you define it as closely as possible to the service that you offer. So the final piece I wanted to cover before we jump into tariffs is really all about a path to compliance. I think the thing that we talk about with international merchants all the time is just first get an assessment. And the assessment will be everything from, your economic nexus, physical nexus. We'll do it. We'll evaluate that. I think also your quote to cash or order to cash process, what platforms you're selling on, where do you commit orders, what's the logical area that you need to integrate for either calculations or consumption of those orders, to drive the reporting and compliance process and the filing process. So understanding quote to cash, understanding back again to the products you sell, defining those correctly. So it's a multi-tiered approach of understanding your business, and then how you're doing business today, the different channels you're selling on, and building a strategy together. The Nexus study, again, is critical in terms of understanding where you have the state exposure. State registrations as an international seller, there's some interesting things there, in terms of what you require to get registered. And there's different paths, whether you do online registrations, the paper registrations, which are less restrictive in terms of international sellers. So there's some areas that you can get around, but there are specific things that are common around having some type of a legal address, and you can get that through a registered agent, a virtual address, things like that. Having an EIN number, having a U.S. bank account to pay the states the sales tax liability you owe. A lot of those are core requirements, for doing business in the U.S. From a cleanup perspective, what we find is we will work with an international seller, and their product is taken off, right? They're doing a lot of sales in the U.S. It's a big market. And they're like, hey, we should have been collecting in 10 states. What should we do? And what we'll do is we'll look at, how far back the exposure is. We'll do a liability exposure analysis off of that. And we'll give them a couple paths. One might be a voluntary disclosure, which is you're going to the state to limit the look back period 3 years. It starts to make sense when you have, maybe issues back 6-7 years even. But we also have a path where sometimes it's maybe just a year, and we can register you with an effective date, previous year or months, and handle all of those past due filings. There can be some penalties and interest associated with that, but sometimes what we can do is request like an annual filing to start, which reduces the P&I versus a monthly down from 12 months to 1. So there's ways we can kind of play the system to help you really reduce that P&I. But I think that the message I have here is it's never too late to take care of it, to do the cleanup work, because obviously your investors, your path going forward, you want to make sure that your business has low risk on the compliance side, that you've addressed any issues, and there's a path to do it. The final thought is, again, with all this complexity we've talked about across the US, it's technology plus tax expertise. We find a lot of international sellers come to us and say, we don't know anything about sales tax. Like, we need your help. And there are products in the market today that will, have really good software. Hey, here's the software, but you don't really know enough about tax to manage it. So putting someone on a self-serve path can be a challenge. So I think the key thing is, when you partner with a technology provider, make sure you're getting the right partnership where they can fill some of those knowledge gaps that you have, because really at the end of the day, it's about saving time, reducing risk, and getting it done right. Checking the box on your fiduciary duty as a company selling in the US according to the state rules to collect and remit sales tax.
Hi, Matt. So yeah, just before we jump into the tariff section, we've actually had a few interesting kind of comments come through from the audience that we think would be, quite relevant now.
Sure.
When it comes to cleanup, firstly, someone's mentioned, is there any kind of requirement to go back so many years, or is there, a statute of limitations? Is it state dependent? How would that kind of work? Is there anything, if I've been selling for 10 years, do you think I have to go back all those 10 years, or is there a bit of a 5-year gap kind of thing?
Yeah, states have a limitation. If you haven't been doing any filing or reporting, the most states are 7 years look back. California is 8 years, and Texas, and it's always going big, can go back in infinity, which is always interesting with Texas. But you common will be, probably 3-5 years in that range. I think if you are looking at a 10-year horizon, that's where a voluntary disclosure can make sense, because what that is, you're going to the state, and someone's representing you. They're not providing your company name to offer up the fact that you're disclosing, hey, I should have been collecting, and I want to limit my look back period 3 years, and then we'll clean up the last 3 years. So all the VDA does is it limits that look back period for 3 years. And that can really make sense if you're looking at really more of an extended period of time. But we find that a lot of merchants and sellers, economic nexus went into effect in 2018. And a lot of them don't have even a 3-year look back period. Maybe they started selling a year or two ago. So I think we want to look at it in terms of, one, we want to clean it up, but two, what's the most cost effective path to do that? And a lot of tax service companies will say, hey, we should do a VDA. And it takes care of that year or two. But I think there's also more cost effective ways to do it, with previous year registrations, and handling those past dues. I think there can be cleaner options to do that, but it all depends on your situation whether a VDA or not makes sense.
Okay, perfect. Thank you. And I think the
Sure.
next bit we're going to look at is
Yes. So there's been a lot of chatter, a lot of conversations about this all over the world, as the current administration is trying to kind of make some changes to commerce and doing business with the U.S. and doing it in a really short period of time. And so I just wanted to cover briefly some of the things that are in play. Currently, there's a 90-day negotiation period with countries in place. There is a minimum country tariff right now of 10%. That could go up or down depending on negotiations. China and the U.S. are really in a tit for tat. I mean, they're back and forth, and I think it's stopped now. I think they're like, okay, enough is enough. Like, I think they're going to come to the table, but we'll see what happens. And there are some sector specific tariffs, steel, aluminum, things like that. Those, like, sometimes when countries do that, if you have an oversupply situation or you're trying to support certain fair practices, that can make sense, when you focus on specific sectors, versus like a full tariff across every, product type. And the last piece, this is the de minimis exemption, which there were 1.4 billion deliveries to the U.S. last year under $800. And that was exempt from tariffs, until recently. And so you think about the volume of those packages and the impact as an international seller. If you're selling into the U.S. and you're getting purchases from my daughter, hopefully it's under $800. You're bypassing those tariff laws. Well, that's been ended. They've ended the de minimis exemption. I think that has pretty significant impact across, commerce and international sales in the U.S. But I think the biggest thing, where we think about is the fact that this is all about its disruption. And I talked about recently, the bigger companies, the enterprise companies. There's different things that they can do and leverage to offset this risk, right? In terms of maybe they have different production supply chain channels they can leverage, distribution channels. They get maybe some special exemptions from the government. So there's things in play there, obviously, that they have more flexibility. They're more diversified across the products and services they sell, versus an SMB company that may have very centralized supply chain, or maybe, have only sell a specific product or couple of products that have impact. So it's about disruption. And I will tell you that we've had numerous conversations with our customers about this, that maybe have their supply chain in China or Thailand, or it has impact to the point where the question is, like, if I'm going to get applied a whatever 100% plus tariff, do I just send the order back, right? Because I can't justify that price because it basically eats into my entire margin, and I start to lose money. So these are important conversations that are happening. But I think the voice that we want to make sure is heard is the voice of the small and mid-sized business. So, and then here are some of the strategies we've heard from different companies that we've spoken to. One is simply the concept of, we have a good product. We're confident in our brand and our product, and we're going to set up logistics with a 3PL in the US, and then faster delivery, reduce shipping costs. But we're going to, if we take a hit on the tariffs, so be it. But we want to make sure that we're competitive in the US because it's an important market to us. There's definitely been scenarios of like, let's get as much product over to the US as we can in the interim, while all of this stuff is being hashed out. So that's another play where you just oversupply, overstock, and so when everything changes, you have enough product in the US to sell for a period of time. Changes to the supply chain, that takes a lot of time, and it can take a lot of time and cost. And it has risk too. But shifting countries for production and sourcing. So we had one company we work with that has shifted everything from China to the US. But again, it's a significant undertaking in a short period of time. And I know also, like, if you are using another country, there's a lot of interesting negotiation that goes into making sure that you're prioritized. Your product is prioritized within their manufacturing. And if you pull out of that, right, then there's going to be some interesting negotiations if things change and you want to move some back, right? So it's a difficult thing. Another thing is really just getting really focused on exposing the landed cost estimate. So when you think about landed costs, it's the price of the product, it's duties, it's tariffs, it's sales tax, it's insurance, it's all the associated shipping charges. All of that goes into a landed cost, and so now starting to show that that true cost to customers, I think that's becoming potentially more of a priority. And a lot of companies will use UPS or FedEx to charge it or apply it, but that's becoming more of a priority. Another is just, hey, we're going to delay our launch. Like, there's a lot of uncertainty. We saw a dip in terms of just activity in March because a lot of companies just pulled back and they said, hey, we're going to wait to see what happens. And these are some of the international sellers that we work with. They just said, hey, we're going to take a wait and see approach. Going non-US, right? I mean, I've heard some things about like the Canadians like protesting purchasing US goods, and that was interesting. And so diversifying away from the States. I mean, we are a big market for global consumption, but at the end of the day, right, it's you have to do things sometimes in the short term to keep your business profitable, growing, and so on. And so sometimes that could be some diversification. And then the final thing is just the wait and see approach, right? It seems like it may have already changed while we're on this session here. There may have been a new rule or something rolled out. So it's moving so fast. Some companies are just taking the wait and see, but they are looking at what's the best case, worst case, and how do we make sure that we're set up to support either situation. But the wait and see approach is a lot of things. So we're seeing that from a lot of companies out there today.
That was really interesting. Thank you so much for all of that, Matt. I think, yeah, we've got a few questions from the audience, but one thing I think that we would look at, because it was really interesting to me when you mentioned like 12,000 different taxable jurisdictions, I think. Obviously, a lot of people that might be watching today, we're used to like a VAT system where, we've kind of got one VAT rate, maybe, well, one main VAT rate, some reduced rates per kind of country, but it's, the same across kind of the country rather than per kind of county. Is there anything that, when a UK or European business looks to expand into the US that they really need to change their way of thinking? And is there any main pitfalls that you tend to see when it comes to, the initial expansion, like any common, things that you need to be made aware of, really?
Yeah, so I think, I mean, when you think about the whole concept of 12,000 taxing jurisdictions, you have to think about accuracy from a couple of levels, right? First is I want to make sure I charge my customer the correct amount at checkout. So when I talked about the different taxing boundaries, you can almost think of it like a Venn diagram, right? You've got your state rate, and then you got county rates, city rates, and special taxing jurisdiction rates, and some can overlap and so on. But the key thing is that you have to put a pin on that rooftop address and apply the appropriate rates, and it can vary. Some state, there's like an example in Colorado where it varies. If you're on one side of the street, the rate is different than if you're on the other side of the street in the same neighborhood, which is a very extreme example. But they drew these boundaries, accordingly, and you have to align with them. Now, the nice thing is there's a lot of platforms out there that have, rolled out native calculation options. Shopify has Shopify Tax, for example, and so on. So, you're depending on that platform to calculate accurately. We have integrations to other platforms as well. And some companies use our API to calculate. When we calculate, we use the street address and we interpret that to GIS coordinates so we can apply the appropriate jurisdictional rate. The other key thing, though, is then how you file it. And that's, I think, Liam, where we see some issues is, making sure that they take all of that data. When you file a state form, most states are going to have a state administered form. So you have to file, on one form, but you have to break out all the jurisdictional amounts, accordingly, and exemptions by jurisdiction within the form. And so I think that's something where we see, with companies, is sometimes the reporting, the way they reported the amounts were not necessarily accurate. And I think that's really important because you don't want to be red flagged as part of, any type of reporting, because there's obviously some audit risk. So I think the key thing is making sure not only do you calculate correctly, but you report it correctly and on time. And then there are, back to what I mentioned, the state administered, there are a couple of states, example is Colorado, where there's 63 locals, and they require Denver is part of a home rule location where you are required to file a local return with Denver along with the state administered return. So there are just a handful of states. Alaska is another one. They don't have a state sales tax, but they have locals you have to file to. But for the most part, most states are state administered. So it's one form, but it's just how you report it accurately with all the jurisdictions.
Okay, yeah, so I think what that kind of leads me perfectly into something else that I was kind of thinking of. If we are registered, let's say a seller is collecting sales tax in 5 states, and they do have all these different kind of taxable jurisdictions within that, different taxes to consider. How hard is that then really to stay on top of the filing deadlines and reporting requirements? I take it, as you've mentioned, it's all under the same kind of report. They don't need to worry about like multiples within that same state, or does it sometimes vary on the states, really?
Yeah, well, the state will assign you a schedule, whether it's monthly, quarterly, semi-annually, and then sometimes, you may get an annual schedule for a couple. The key thing there is, you have to file for that period, and typically it's the subsequent month after that period is over. And then you have till typically the 20th of the month of that subsequent month to file on time and accurately. If you don't, you could be subject to penalties and interest by the state. So the key thing again is knowing that what your calendar is, and making sure that, if you're working with a partner, they have all of your calendar information by state. There are some states that are going to be monthly. There's a few quarterlies, and they're filing, appropriately on time in those states. The biggest thing that we tell our customers is just make sure you have funds in your account when we file, because there needs to be enough money there when we pay the states. Obviously, they're going to pull the funds via ACH through your approved bank account. We just have to make sure that the funds are there. If they're not, the state would decline the filing, and then we would contact you and you would replenish your account, and then we'd file it again. So it's not like the end of the world if you don't have the funds in your account. But that's the biggest thing. Whoever you're working with, I think the comment will be is make sure you have funds, and they'll want funds typically at the beginning of each month for the previous filing, for the filing period. And the reason is there are some states that give you discounts for early returns. Texas, Maryland, 1.5%, 1.25% on the tax owed, which is a nice little added benefit. And so, to get those credits and discounts for filing early, your provider should be able to support those.
Yeah, and I think another thing as well, when it comes to brands, as we both know, obviously you've mentioned you've been in kind of like the sales tax space for 13 years. So, with like e-commerce brands, they can really grow off the market really quickly. How early would you say is like too early to really consider your sales taxes? Or would you say it's maybe the same approach that we see? It's like as soon as you think about selling, it might be best to explore it. Yeah, what would you kind of come in from like, personal experience for that?
Yeah, again, I think first is what's your strategy in the U.S.? Are you going to have inventory, or are you going to ship, from outside of the U.S.? So those are obviously important. Are you going to be using like a 3PL, or are you going to also do you have a marketplace strategy, because that can have impact with Amazon, for example? But I think the one thing I would say is, you have an idea of, hey, we have some estimates on or forecasts on how we expect to grow over the coming months, years, and so on. I think it's important to recognize, though, back to that one slide, when you get to about 2 million in run rate, based on $100 average product, again, leveraging personal consumption and overlaying that with the state economic nexus rules, you can be collecting in 5, 6, 7, 9 states pretty quickly. And so I think that the companies that we worked with, even for new product launches, and we've had some companies that have really taken off in terms of like supplements, protein bars, things like that, where they literally start with 2 states based on their physical exposure. And within a year, they're in 25, 30 states. So I think the biggest thing is you want to get in early to identify, making sure that you're set up early. And then as you grow, right, you're getting notifications for economic nexus. And then you're able to just easily, your provider can register you in new states as required as you cross those thresholds. So I think getting in early makes sense. But if you're just selling on Amazon to start and that's your only plan, I think you're okay without getting registered for any states, because Amazon's taking care of it all. There is no direct to consumer strategy. So I think that's okay just to go that route and not worry about it at that point.
That makes sense. I mean, looking at it from, I guess, a practical example, if we were to, I don't know, let's say I start a business, and I was to say, firstly, ship from the UK across to, consumers in multiple different member states. Well, sorry, states. See, I'm coming from a EU with member states, but yeah, within the states, within the US, is there anything to kind of consider there, or is it more so I need to start really looking at it when I start looking to explore and holding stock locally with a 3PL?
Yeah, I think it's definitely when you start to make more of an investment in the U.S., because the 3PL obviously is a natural trigger. But what is interesting is we have worked with companies that ship from outside the U.S. back to the de minimis exemption that is no longer there, and they've taken advantage of that. They run a fine business shipping into the U.S. And just to give you an example, we were up at a session in Canada last year, and we asked the question to the audience, how many people sell in the U.S.? And they all raised their hand. And we said, how many companies get more than 50% of their sales in the U.S.? And the majority of them raised their hand. And then how many are collecting sales tax? And only a few of them raised their hand. And so that was a big, obviously, like risk area, because they're going direct to consumer, they're shipping from Canada, and most of them were not charging sales tax. And there's a good chance, they were triggering economic nexus in various states, but they haven't dealt with it yet. And I think that's where, again, if you have a really popular product, Word spreads. Obviously, there's a lot of different marketing channels now. Social media is a big fire starter in terms of just driving sales. And I think it's just important to kind of understand what your volumes are. But if you're under the thresholds and you're selling, as a remote seller, from another country, really, then you just have to worry about landed cost minus sales tax. You don't, you're not required to collect sales tax if you haven't triggered the state nexus requirements.
Perfect. Thank you. And we've got a few, just comment questions whilst we're going into it. The first one that someone's asked here is there any kind of exemptions relating to product category for printed matter like books and magazines, or is that something more so that, could be state dependent at all?
Yeah, there can be. Yeah, there can be. So a lot of times that can be taxable, but there can be things tied to education that will have some exemptions associated with it. But there are categories specific to, printed material, books, magazines, et cetera, that have exemptions. And then on the digital side, again, some states will tax, digital books and content, while others will exempt it. So, it varies by state in terms of the exemptions and taxability. But yeah, there are some on the printed side. Some states will have, but for the most part, I believe it's going to be taxable, but there are some exemptions there.
Perfect. And I've got a couple of questions from Helen. She's asked a couple of questions here. One is, when did the de minimis exception stop? Am I correct in the understanding that that has now kind of ceased with that?
Yeah, that was just a recent decision. I was actually talking a couple of weeks ago, and they had original rules that went out based on like the cost per package, and that now has changed as well. Like, it changed from when I talked about it 3 weeks ago to like a week ago. But I know that's now in effect, where the de minimis exemption no longer exists, for tariffs. And so, but I think it's, is there a negotiation? Is that part of potentially the negotiation? Potentially, right? I think there could potentially happen. So, and I think there's a lot of, even U.S. interesting enough, U.S. companies that direct drop ship from China to U.S. customers, and so it impacts them significantly as well. So, so I think it's something that's we'll hear more about over the coming weeks. But they've been pushing for a while to get rid of that exemption, and I don't know where it's going to land though. So I think that will be hopefully solidified. But as of today, it no longer exists.
Perfect. And yeah, just one last question, but because that's all we've got time for, unfortunately, today. But one
Sure.
last question is, how do we find out about a service to do a short risk exposure so we can plan?
Yeah, sure. So, we Zamp, we offer some exposure analysis for for customers, and we can do that as well. Whether you're a prospect just interested in learning more about our services, or a customer of ours, obviously we have built-in technology that does the ongoing tracking for our customers. But if you want a nexus assessment or an exposure analysis, we can do that at no charge. We have per our partnership with Simply VAT, we provide those kind of services just so you have some transparency in terms of, like, do I have exposure? What is it? What should my strategy be? I know there are, some companies do charge for it, but I think it's all public information, and it's just a matter of understanding where, what your physical setup is today, and then taking all of your order volume. You'll go back to January of 2024. So, because their states look at either previous calendar year, current calendar year, or trailing 12 months. So we'll take that data set across all your channels, and then we'll apply it to the state economic nexus rules. And we'll say, based on our analysis, you triggered exposure in these 12 states. And of the 12 states, here are the dates that you triggered it on. And then based on the sales you've done since then, here's what, using an average sales tax rate by state, here's your potential exposure. And then you can make decisions off of that. Whether do we just register going forward for some states where it may not be material, Do we register with past due effective dates and so on? But you can build that game plan off of the data. I think getting that analysis done, though, is a really valuable thing if you're selling into the US.
Perfect. Thank you. And thank you, everyone else, as well, for your questions. Unfortunately, that's all we have time for today. But either Matt or someone from the team at Zamp will follow up with you to make sure that your questions are answered. And yeah, as you can see, you can get in touch with Matt using the email address here, or you can get in touch with us and I'll be able to make an introduction for you as well. But yeah, thank you so much, Matt, for your time. It's been really useful, and I think I can speak for everyone who's watched us today. It's been very educational and really insightful. And yeah, thank you so much.
Thank you, Liam.
Thank you.